All right, we're live. Hey everyone, and welcome to today's podcast, or webinar rather. I'm joined by Simon and Terry from Blue Tractor Group, and we have some interesting topics to discuss today. Just as a sort of intro message and housekeeping points, if anyone has any questions over the course of the webinar, you can post them in the question box below. It should be on your screen. Additionally, if you need the recording afterwards to look at it, we'll distribute that with everyone on the line as well, or everyone who's registered. So the topic for this webinar is how to protect your proprietary index ETF strategy. And we're really hosting this webinar to discuss primarily the semi-transparent ETF structure and how this ties into our expertise in offering custom indexing solutions to our clients. So our clients and partners generally work with us to turn their cutting-edge investment strategies into custom indices. And the goal is often to convert those into an ETF structure or a direct indexing product or any other wrapper. The major concern, however, is that comes up in a lot of our conversations is the issue of transparency and what this means around in terms of safeguarding your strategy and safeguarding your strategy's performance over time. As many of you probably know, publishing the daily holdings of a strategy, which is the case in a transparent ETF, this may lead to issues around free riding, front running, or even replication or sort of back calculation of your underlying strategy. So semi-transparency offers a solution to this, which Simon and Terry will tell you about shortly. But in general, over the course of this webinar, we'll cover the core issues around transparency, how a semi-transparent structure works, how it can be utilized to mitigate some of these issues I just mentioned. And I hope this webinar is valuable for anyone who is looking to construct new index products or enter the ETF space. So I'll just give a quick introduction to myself and Index One, and I'll hand it over to Simon and Terry afterwards to do their respective intros. So I'm Alex, and I'm the CEO of Index One. And what we offer is essentially a custom indexing platform. So it's a calculation solution which helps you design, backtest, and run live calculation of various custom index strategies. On top of that, we also have various index dissemination options, ways to integrate your index with third-party platforms. And this really sort of helps our clients either launch index-linked products or produce indices for tracking purposes or research. There are many different types of use cases that we cover. But let me hand it over to Simon to give a quick intro to himself and after next.
Thanks, Alex, for having Terry and I on today. Delighted to be here, and it's a very interesting topic we're going to talk about today. Blue Tractor, we're based in New York City. I'm the co-founder along with Terry. We have an SEC-approved ETF wrapper technology, commonly referred to as semi or non-transparent in the U.S. market context. It currently powers ETFs on various U.S. listing exchanges. And delighted to be here. Looking forward to digging into today's topic.
Hi. Once again, thanks, Alex, for having myself and Simon alongside yourself today. I just add a little bit more flavour to Blue Tractor. As Simon said, we are one of the companies who received exemptive relief for what's termed a semi-transparent ETF. But besides that, Blue Tractor is recognised for bringing innovation to the market. to push the boundaries of the ETF space back to allow investors and managers greater choice, not just in the US, but in other jurisdictions around the world. And that's our focus.
Excellent.
Makes sense. So the first topic I want to cover is just firstly around the sort of traditional transparent index ETF. So what are, Simon, the main concerns an investment manager needs to consider as it comes to running a transparent index
Yeah,
fund?
sure. Let me provide some context and background, and then we can kind of together sort of work towards the issues of concern that investment managers might think about. So today we're talking about, passive or index-based investing, because often, I mean, some of you on the call today might be thinking, well, semi-transparent, isn't that focused on active management, active stock picking? And yes, it certainly is. But today we're focused on the passive or index space. And, that really is the largest part of the ETF market, as many of you know. I mean, think of SPY that tracks the S&P 500 or the QQQ family of ETFs that are focused on NASDAQ, all the MSCI, FTSE, et cetera, whether they're broad-based or narrow sector-specific ETFs, they're tracking an index that has been developed by third-party providers, and they're typically asset managers to launch ETFs, license these products. And, anybody on today's call can do that. They can go out and license any one of these, well-known indices and, become one of many doing basically the same thing. So really what we're talking about today is what Index One facilitates, which is custom or bespoke index construction. So basically, as an asset manager, you've selected or decided that you can get a slice of the market that you think provides you an edge or a return, an attractive return profile that doesn't exist currently out there in ETF land. So you're trying to develop something that you spend years of your research, your effort, back testing, etc., and you put together this product or this index now, and you go, well, how can I protect my IP? If I just published it, then everybody else on the planet can do the same thing, and all my work has been for naught. That's what we'll focus on. And Alex, I know you're going to come back in a few minutes with some of the main concerns about that kind of transparency on an index. But let me just first set the table on how the ETF market works. Now, if you launch a fully transparent ETF, there's no requirement for you to publish your index. There's no requirement to publish the composition or the specific rules of the index. Now, you might be thinking, well, that's great. Simon, you just said I'm going to be transparent, but if I don't have to publish my index, how can anybody know what I'm doing? Well, the devil's in the details, because under the rules by the SEC and the CBI, being transparent means you actually have to publish every day the actual portfolio of the ETF. So if the ETF is tracking the index, even though the index itself is not published, ironically, you're publishing the exact portfolio, so therefore your index is being exposed. So that's the sort of subtle detail that some folks don't appreciate when they launch a transparent ETF. Now, because you're fully transparent via the published portfolio, you're now exposed to nefarious third parties that can look at your portfolio and say, okay, well, there's the index. Now I'm able to do certain things with that index that, Alex, I think you'll talk about right now that are to the detriment of the asset manager.
Yeah. I mean, in relation to what you said around not just discovering active strategies, but also any custom index, I think that's almost a more important factor as it comes to custom systematic indices, because sort of once the methodology is out, it's out. You can't sort of undo that.
Exactly.
Whereas for active discretionary, you will make picks over time, and those will obviously then change depending on your process. But I mean, one of the major issues is around front running, and that's actually something we've done a bit of internal research on and published a paper as well, which we can we can send to anyone who's interested. But we've basically covered the major index, major ETFs, and looked at how much front running occurs at the index rebalance. So basically, in between the announcement of index changes and the effective date of such changes. And we came up with a figure of around 7 basis points per year for the major ETFs. And that's a really significant number considering the size of that market. By rough calculation, it's just over 10 billion a year as a cost. And that's, nothing to scoff at. It's definitely a big number, and ultimately it's a drag for the ETF issuer, but also for the end investor who has to deal with worse performance.
Alex, you mentioned that paper the U Index One undertook on the cost of front running, and that was reinforced by a research paper that came out of the University of Illinois Chicago, and they estimated the cost of front running to these index rebalancing at 9.7 basis points, significant costs. Now, the semi-transparent ETF structure won't really add value, but it will protect the value. That 9.7 basis points, that's what you'll be protecting. But let me sort of go back a little bit what I said there. And what is a semi-transparent ETF to begin with? It's an ETF, just like any other ETF. It provides lower costs, and it's as efficient tax-wise as any fully transparent ETF. So there's no difference in terms of cost or tax efficiency. In terms of the end user purchasing and selling their ETF share, absolutely no difference. They won't know whether the issuer or the index provider is using a Blue Tractor semi-transparent ETF or a fully transparent ETF. Where the difference is the licensee, the index provider. They can, as Simon said, go with a fully transparent ETF under Rule 6C11. And, there's some disadvantages of that Simon's already highlighted. But another disadvantage of that is the fact that if your assets under management grow, or, people think, wow, this is a really good index, I want to replicate that. You can't change. You can't come into the you can't turn the opacity level up to stop those guys doing that. So you're tied to that mast. With a semi-transparent ETF, you have the flexibility to run essentially as a fully transparent ETF every day. But when you're rebalancing or whenever you like, you can turn the opacity level up to throw off front runners, throw off freeloaders, stop copycat funds, etc., etc. And I'll come back to what I mean on these things. But the semi-transparent ETF structure that Blue Tractor offers is unique because it offers this flexible transparency option, at the same time safeguarding shareholder wealth from front running and protecting the intellectual property of the licensee, the index provider. Now, while it's doing that, it also provides enough information every day to the capital markets, which is essential for tight pricing in all market conditions. So it really is the novel premier structure that's out there, because no other structure can compete with this. And that's what anyone looking to bring their own index strategy via Index One to the market in a semi-transparent ETF structure provided by Blue Tractor, they're the benefits you receive by going that route.
That's right. It's interesting. If I can just add some color as well. I know we're talking to some folks here in New York about the arbitrage and the index front running market. There's whole groups of hedge funds and investment banks that have trading desks, typically called program trading or index rebalancing desks, that's what they do. They try and figure out and front run all day these broad-based index, Russell, S&P, Dow, FTSE, whatever. I know there's a group out of Millennium, one of the bigger premier hedge funds in the U.S. that has a whole team down in Puerto Rico. That's all they do, and they make a lot of money doing this. So it exists. It's for real. You can't dismiss it, and it's just a fact of the marketplace of your predatory third parties taking advantage of market inefficiencies. Terry, let me just describe a bit of color about the market. We call it semi-transparent. Here in the U.S., that's what it is. It's a semi-transparent market that the SEC has decided exists and they regulate. It's interesting. In other jurisdictions around the world, there is no such thing. They're just called ETFs with delayed portfolio disclosure, meaning that they, in lieu of full daily transparency of the ETF portfolio, you put up a different kind of basket that allows you to not disclose your portfolio. So really, it already exists elsewhere. It's just in the U.S. where we have this kind of hang up on the term semi-transparent, which I find kind of interesting. People think the U.S. is the land of the free, but often we have more regulation here than anywhere else, ironically. Just for some numbers, the first semi-transparency in the U.S. launched in winter 2020, just after the COVID lockdown. It's about a $7 billion marketplace now, so growing. And we're pretty excited to see there's about 55 ETFs now that have launched. So certainly it has its niche, it has its place, and we expect this to continue going forward. Thanks, guys.
Yeah, just to kind of, for anyone who's listening who might not be as familiar with the wrapper, could you just explain we don't have to go into the exact details around it, but on a high level, how the wrapper actually works in terms of the disclosure.
Okay. On a fully transparent ETF, Simon mentioned the portfolio has to be disclosed every day. That portfolio is disclosed via something called the creation unit, and that's what the capital markets group use to price, hedge, and arbitrage. Every ETF has to publish this basket, this creation unit, and that's what it's used for. With the blue tractor structure and these other semi-transparent structures, you don't have to disclose the full portfolio every day. Okay, in blue tractor's instance, we have all the names of the securities in the basket, which is fundamental, we believe, for risk control, type pricing, etc., etc. But the way we hide your IP and protect against freeloading front running is we scramble the weightings every day. So Apple may be in your portfolio or your index at 3%. What the market will see on, say, today would be Apple at 2%. Tomorrow it might be 2.5. Next day it might be 4.5. It bounces around. So no one actually knows the exact weight of Apple in your portfolio. Now, when it comes to someone freeloading, and what do we mean by freeloading? They're actually copying your strategy. And it's a well-known process in the market. We have one that's recently been announced. BlackRock and Goldman's, two of the biggest companies out there, are copycatting, freeloading JP Morgan's equity premium income ETF. There's a real example for you. So don't think we're just saying this is theory. These things happen in practice. And that's one example, but they're numerous. And what that actually means is every dollar that goes into their copycat, their freeloading fund, is not coming to you. So it's gonna hit your P&L. So that's why you want to protect against freeloading. And Blue Tractor, because we jumble the weights every day in a random way, that stops freeloading. Because if anyone tries to copy the basket or the portfolio that we publish every day, transaction costs of keep buying and selling will kill them. Okay, so their returns are going to be way, way, way off what yours are. Okay, now in terms of front running, again, we've seen the costs from Alex, and I've mentioned it from the University of Illinois. Simon mentioned these groups in most of the major houses. Again, it's real. And that's to the detriment of your returns and your shareholder returns. So, that aside, if you're publishing your portfolio every day, people in other countries, other jurisdictions, not in the same contemporaneous time zone as you, can get ahead of you again, drying up the liquidity of some of your securities in your index, making it more costly. And a classic example of that is the ARK-K ETF, very popular in the US, but now is listed on the Japanese markets, so non-contemporaneous time zones. Once the basket's published in the US, the guys in Japan can see what's going on. They can buy and sell before the US market opens again, drying up liquidity. So these are real practical consequences of going fully transparent under 6C11, as opposed to coming into the semi-transparent world and using something like the Blue Tractor Shielded Alpha ETF wrapper.
Thanks. Yeah, I think that makes a lot of sense, and appreciate the thorough explanation. So the wrapper has been around now for a while, and there's certainly some talk about it. I mean, what would you say are the main things that are misunderstood or misconceptions about the transparent ETF structure?
Sure. I mean, Terry, let me start this, and then you can jump in with some more details. I mean, one hears, Alex, from the pundits, and by that I mean the ETF press and the like here in the US and elsewhere, that these products, semi-transparent ETFs, aren't as tax efficient as a fully transparent ETF. That's the first big one you hear. The second one you hear about is that these things don't trade as well, especially in high volatility, because the capital markets, the market makers, etc., don't have full visibility under the hood. So how could they possibly trade these ETFs as efficiently as a fully transparent ETF where they know the exact portfolio and the exact weightings? Like those are like the two big ones you hear about all the time in the press. And I mean, it's just, to be honest, it's nonsense. It's true that going back to the tax efficiency, it's true that when these products first were approved by the SEC in the US in late 2019, none of them, including Blue Tractor, had what's called custom basket relief. These are special purpose portfolio baskets that the capital markets use to conduct what's called in-kind transactions to mitigate capital gains when the fund rebalances their ETF. So it's true, initially, I would agree that there was perhaps some tax inefficiency versus fully transparent where those things exist. But that's changed. I mean, at Blue Tractor, we received our custom basket relief in 2021. So today, ETFs that use Blue Tractor are as tax efficient as a fully transparent ETF. There's no other way to slice and dice that. It's just a fact. Number two, the idea that these things don't trade as well, the market makers, and when I say market makers, firms like Citadel, Jane Street, Susquehanna, GTS, RBC, Virtue, et cetera, can't handle these ETFs is, again, nonsense. First of all, these are super sophisticated trading firms. But B, the information in these baskets that are published in lieu of full transparency are highly correlated to the actual portfolio and have low tracking error. So therefore, market makers understand their risks, can therefore hedge their risks, and therefore can conduct efficient prices. And when I say that, I mean tight bid offers, arbitrage to keep discounts between the market price and the NAV of the fund super low, et cetera, et cetera. And we've seen, I'm not going to call them black swan, but we've seen some pretty disruptive things happen the last 24 months. Vladimir Putin marches into Ukraine. The Fed continues to raise rates, not just here in the U.S., but globally, causing sort of economic shocks. despite all those things happening, spreads have been super, super tight in the semi-transparent space. In some cases, even tighter than fully transparent. So again, these are just myths that I wish the press would stop writing about and move on. Terry, any other thoughts?
Yeah, I'll just add one further thought to that, and that is the myth that you can't grow assets in a semi-transparent ETF wrapper. Once again, I'll give you an example. The last blue tractor licensee, Summit Global Investments out of Utah, launched their fund of funds ETF using the blue tractor semi-transparent ETF back in March this year. They launched it with $2 million. Today, it sits at over $105 million. So once again, the proof of the pudding is in the eating. You can grow assets in a semi-transparent ETF wrapper, but you've got to bring something to the market. If you're just going to launch another index that's going to track the S&P 500, you're not going to grow assets because they're already out there. You've got to be novel, innovative, and that's where the guys at Index One can help you bring your novel index strategy to market.
Yeah, that's a great point, Terry, because if someone has a good idea out there and wants to develop an index product that captures a slice of the market that gives them an edge, they think, and that's, as you say, that's what Alex's team can do for them. Put on the now the mindset of the investor. They're approached by their advisor to say, hey, or they see something on TV or whatever about this ETF. At that point, they're thinking, that's an interesting market opportunity. That's an interesting potential for return. That's an interesting management group. I like what they've done in the past. None of them think, hey, is this semi-transparent or transparent? No one does. No investor thinks that way. All they care about is, what's the strategy? What's the team behind it? And can I make money? That's at the end of the day, that's all that matters to investors. None of them care whether it's semi-transparent or transparent. So how you get there with your ETF wrapper is irrelevant to the investor. All they care about are the other things I mentioned.
Yeah, makes sense. Makes sense. So just like looking forward in the semi-transparent space, what are the kind of main developments you're expecting or hoping to see in over next year and beyond?
Well, as I said right at the start of this podcast, Blue Tractor is recognized as being innovative in the ETF space. And at the moment, the licensees that we can offer a wrapper to really comprise of any US manager with long only domestic equities, Canadian, Brazil, Mexico. For the last 18 months, 2 years, we've been in intense dialogue with the investment management division at the SEC to try and expand that to actually bring in short positions as well. Okay, and we're the ones pushing that boundary as best we can to get that relief. Obviously, we want to expand the market even further because when I say the market, I mean the type of active products that we can license to, because at the moment we're restricted to US domestic equities, Canada, Brazil, Mexico. We can't bring into our framework anyone who's got international equities, i.e. Japanese equities, Australian, and anyone who's got fixed income or uses options for wealth protection. So we're pushing forward the boundary as best we can to bring short positions into the framework. And we're also then going to try and bring, an expandable universe, bring in fixed income instruments, bring in international equities, bring in options, because, the Blue Tractor structure actually is well suited for all those. Okay, so it will give investors more choice. It will give managers more choice as well. And if the market doesn't want these things, they won't take them up. And we don't believe it's for the regulators to make that decision. We believe it's for the market to make that decision.
Exactly, Terry. Exactly. As I mentioned before, the word semi-transparent exists only in the context of the U.S. I mean, you look at Canada, you look at Australia and other markets where they have products that don't disclose their portfolios every day. They're often called portfolio delayed ETFs, aka semi-transparent, really, at the end of the day. And none of those markets preclude their ETFs from investing only in their domestic equity market. So I echo Terry's sentiment that let's not have the regulators decide what the market wants. Let the market decide on their own based on a full menu of choices. And that's what I would heavily encourage. And 2024 will be an interesting year, Alec, because here in the U.S. we have a major election coming up, as we all know, and we'll see what happens. Often in these elections, there's a lot of changing chairs, revolving chairs, moving chairs in terms of the Washington bodies, such as the Securities and Exchange Commission. So we'll see who sort of comes in and takes on the job going forward, and whether he or she is more inclined to permit more innovation in the marketplace. The other thing in 2024, we're going to continue to see this incredible symbiosis between ETF service providers and investment managers that are new to the marketplace. It used to be, Alex, in our market, that to launch an ETF was an onerous, expensive, time-consuming activity that could take you months and months and months and a lot of legal bills just to get over the finish line. It's all been streamlined now, as it is now in a lot of jurisdictions, Europe especially as well. And, folks can launch their ETF in as little as, 190 to 120 days for as little as $75,000 to $100,000, because it's a network of providers such as Index One that can do a piece of the puzzle for them. So in your case, you can develop their index. They can then take that index and go to, a white label firm and package that up into an ETF structure with a trust, a board, accounting, back office, et cetera, et cetera. Then they can use Blue Tractor to provide the wrapper technology to hide their intellectual property. So you can see that if you're a sort of an individual that has a good idea, a small firm, you don't need to do this yourself. You can work with a constellation of providers to get you to the market fast and efficiently and at relatively low cost. So those are all the exciting things in 2024 that, I also think that underpin this whole growing space of custom bespoke indices that, you don't need to do it all by yourself. There's a lot of folks here to help you.
Yeah, I think a lay way of putting what you've described there so succinctly, Simon, is this: ETF, the F. Other people will do the E and the T for you. You don't need to concern yourself about it.
Excellent.
And that, that's the best way to describe it in lay terms.
Very good. Yeah, I like that.
Definitely a good explanation. I mean, one thing I'm certainly looking forward to and hoping for is further development on the launch front in terms of cost. I think is one main thing holding back a lot of really great investment strategies or potential products from entering the market and finding investors, and obviously the time to launch as well is hopefully something that can be reduced further. But I mean, just to kind of wrap things up, or to give some clarity on why we're here, with this collaboration with Blue Tractor. I think it's a really great collaboration, first of all, and it really helps sort of bring things together for anyone looking to enter the market, from sort of the early design phase of an investment strategy to building the index, building the back history, running the live calculation, and ultimately also safeguarding that. So making sure it stays away from front runners and other firms who might try to exploit or copycat that strategy. So really excited to bring this forward and find more use cases for this.
Excellent.
Thank you.
Yeah, I mean, in terms of, I think we can pretty much wrap it up there. We've already passed the 30-minute mark, but
Wow. Okay.
if Simon and Terry, could you just let any viewers know how to get in touch with you for if anyone's interested?
Sure. Yeah, just set, well, bluetractorgroup.com is the website URL. And please email me at simon@bluetractorgroup.com. Again, simon@bluetractorgroup.com. And we'll be happy to have an exploratory discussion. Obviously, same thing on your end, Alex. I guess you'll give your contact information as well.
Yeah. So for us, index1.io is our website, and you can get in touch at contact@index1.io. All right. Well, that I think wraps it up. So I'm gonna end the stream here. But thanks everyone who's tuned in, and thanks Simon and Terry, of course, for taking the time to speak today.
Our
Thanks,
pleasure.
Alex. Thanks for having us.
We'll talk to you soon again. Thanks.
Goodbye, everybody.